It's time for In the Money, Stock Market Action on AM 820 News. Here's Chief Market Strategist Gareth Soloway from InTheMoneyStocks.com.
Good afternoon, everyone. Welcome to the show today on this glorious May 4th, Sunday, 2014. It's going to be a fun show today, folks. We have a lot to cover. I'm joined today by my business partner, Nick Santiago, Chief Market Strategist at InTheMoneyStocks.com. How you doing today, Nick?
I'm great, Gareth. Great to be here today.
Excellent. So we're going to have a lot of fun today. We're just going to kind of shoot the breeze about the markets, help you guys understand what happened last week, and kind of get yourselves ready for the coming week. There was a lot of stuff that went on last week, and I think it's worthy to kind of take note of a few different things. First and foremost, you had a lot of choppiness last week. I think the markets overall inched slightly higher. We did see the markets, I believe, on Friday, they inched down just a little bit here. S&P was down about 2.5 points, Dow down 46, NASDAQ down about 3.5. But, I mean, for the most part, it was one of those weeks that there wasn't a ton of wild big up days or down days, even though we had a ton of news coming out, economic news. And just to go over a couple of these small pieces of news that hit the markets last week, I think it's worth taking note. Monday, we saw some home sales data, which was pretty weak, and there's been a lot of speculation, and we're going to talk about this a little bit later, whether or not the housing recovery has stalled and is now starting to head south again. And obviously that's been one of the main reasons, right, Nick? I mean, one of the main reasons the market's actually pulled off its lows is because housing has actually bounced.
Yeah, I mean, that was the main driver. And if you remember back in 2002, 2003, when the housing boom began, that was the main driver to get out of the prior recession. So housing is a very, very critical part of the U.S. economy. And right now, I think it's in stall mode.
Stall mode. Do you think that was, I mean, was that the reason behind the Fed making sure interest rates went as low as they were to try to get that housing? I mean, they obviously know how we got out of it in the last recession. Was that their plan behind it, do you think?
Well, I think it's definitely part of their plan. Right now, I mean, the only plan they looks like that they have is to keep the free money going, and hopefully people will start, as confidence builds, start to potentially invest and maybe buy more homes or more rental properties. But if you notice, a lot of the properties that are being bought, especially here in Florida, are really condos are all being bought with cash. I mean, they're not even taking loans out. So that's pretty interesting in and of itself.
Yeah, I mean, I think a lot of it also, a lot of words been mentioned lately about how, like you said, in cash being bought, and it's not the small investor, it's not the mom and pops buying a place or first-time home buyers. It's a lot of investment properties that are being picked up that are then being rented out. So it's interesting to see if this economic news on home sales and such, does it really start to stall out? And does that mean that the small investor, the mom and pops, aren't able to come in and get loans? Or if they are able to get loans, they just don't even want to bother? I thought that was something interesting that I heard last week is, there were a couple people interviewed about buying homes, and they were like, what's the point? Why do I want to take on that responsibility of dealing with a house, dealing with the problems that come with it, paying the taxes, paying all these fees and so forth, when I could just rent for $1,000 a month or a couple $1,000 a month? I mean, you think that makes sense, Nick?
Absolutely. I mean, just this week alone, I had about $2,000 in repairs myself, so I can understand where they're coming from. But if you look out west, especially in California, you have more and more people living with their parents now that are in their late 20s and early 30s, and that's a staggering statistic. I forget the numbers offhand that I read, but I'm not really all that surprised to see that happening. And people are saying, as you mentioned, why do I need that responsibility? I have to pay taxes on the property, I have to maintain the property, I have to pay utilities, and then I have to pay interest to a bank. So, what's the sense? And I think we're starting to see more of that come across recently.
I mean, do you think there's going to be a push by the government and by some of these investment institutions to really push that whole idea? Because, I mean, back a ways and back for a long time, it was always like, this is how you build wealth. This is how you do it. Is there going to be another push of that? I mean,
I'm sure there will be. I mean, right now, there are so many programs out there funded by the government. You could basically get into a house with no money down again. So, look at Fannie Mae and Freddie Mac. They're just disasters. And, I mean, I don't even know how that ever gets unwound. But, the government will come up with some other scheme. Remember the cash for cars or junkers? Remember that? So, I mean, they're always going to come up with something to entice people into a home. I mean, really, when you buy a home, you should be buying a home to live in it and to live in it with your family. I mean, that's really what it comes down to. Otherwise, most people don't have really any business owning a home.
That's an interesting sentiments, guys, and something we all have to think about when we're going to be allocating our rare resources, our financial money into some area. I mean, is that where we want to put it? That's what we've been told for generations that we should be putting it. But again,
the American dream,
right? That's right.
It's basically the American dream.
So interesting there. And now the last thing I wanted to mention, Nick, and get your opinion on was, I mean, all these banks, right? They lent out so much bad money back in 2005, 07, and so forth, and it all went south. As this economy is slowly recovering, do they still have these bad loans there? I mean, is it still there, or did they get rid of it? Or I mean, what really did it just disappear?
That's a great question. What really happens is they never really own the loans. They originate the mortgage or the loan, and then they really just sell it out. And that's where you got all these mortgage-backed securities that were shipped off. And to tell you the truth, they probably have tons and tons, if not hundreds of trillions of dollars of toxic derivatives still on their books. But with all the free money and with the new accounting standards that have been put in place, we used to have a mark-to-market accounting. Now it's mark-to-model. So who's to say what the model is, right? I guess they could just model any property or any anything at any price, so into the future at any level. So it's very distorted. It's what I like to call Enron accounting gone legal.
That's a great way of putting it. Yeah, don't we all wish we could kind of just make it up as we go with our own financials and say, what the heck? Yeah, it's another Band-Aid. No one will see this, and we'll just go on our merry way. Unfortunately, the individual doesn't get those luxuries.
No. But Enron accounting is now legal here for certain people and for certain institutions. And, we always talk about, I guess you and I, Gareth, about how many people are on public assistance in the United States. It's roughly over 50 million now. But the banks are the biggest welfare recipients of them all, the four large banks. So I find that rather ironic. These guys are still getting free money, and everybody thinks, they paid back the TARP. Yeah, but they're getting free money still to this very day.
If someone gives me free money, I could pay back all my loans too.
Yeah, and they go ahead and they issue a 20% credit card, a 30% credit card to somebody. They make loans to people who have the collateral to back up the loan. They don't loan any money to anybody else. And then they park the money with the Federal Reserve and get interest on that money. So they get free money from the Federal Reserve that pays them interest on that money.
What a great scheme, then.
It's Ponzi would be proud.
There you go. So just getting back to it. So that's what, on Monday we kind of went off on a tangent there, but I think it was a great one. But Monday we saw some home stuff, some home data that came out. And again, it really raised the question of, is this housing market starting to stall out a little bit again? And it's interesting that as the markets have started to stall the first 3 or 4 months of the year, really, if you look at the chart of the S&P, it's been sideways choppy. That's all it's been. And then we're seeing this kind of coordinate with the housing market as well. And it does bring up the question, if the market starts going south, does that mean that housing prices are going to be falling back down? So just something to keep in mind there for those of you that are at home or in your cars listening. Now, Tuesday, we saw a market that was basically flat and sideways. A lot of the Tuesday price action was sideways because everyone was now looking towards the Federal Reserve meeting, the FOMC statement, which began on Tuesday, and it summarized on Wednesday with the statement at 2 p.m. Eastern time. And so the markets going into that from Tuesday into Wednesday, 2 o'clock, were unbelievably quiet, light volume. Everyone was just waiting to hear what the Fed was going to say. And remember, the question was, were they going to withdraw another $10 billion? Were they going to withdraw less? What were they going to comment on? Were they going to let Wall Street believe that they were going to continue to cut money? There were a lot of little nuances that the market was paying attention to. And really, when it all came down to it on Wednesday, we'll talk about the GDP number in a minute, but Wednesday at 2 p.m., the Fed basically came out and said, hey, listen, we're going to cut another $10 billion. I actually thought, I don't know what you thought, Nick, but I thought that the Fed was surprisingly stern on saying, hey, listen, we're cutting another $10 billion. They actually said that they thought the economy was doing pretty well, and which is kind of interesting with that GDP number. Like, I don't know what they're looking at, but, it seemed to me that they're kind of looking at this stage to finish up QE. What did you think about that?
Well, I think they have to. If they don't finish up QE, we're looking at probably the biggest disaster in economic history. So this is an experiment that can go terribly wrong. I think they know they're behind the curve, and they have to start trying to normalize these markets. If you just look at the amount, even with the cut, they're still going to print $45 billion a month. Just think about that number, though. $45 billion. We were at 85. Now it's 45, but they're still printing. So essentially, interest rates are negative. real rates. I mean, let's call it what it is. You and I will never have we'll never see 1% or 0% interest rates on our properties or anything, any loan we're looking to go for. But all in all, I mean, there are a lot of institutions out there, private equity firms that are getting real cheap money still.
Yeah, and so that was one thing that struck me this past week, like Nick was saying here, is so the Fed comes out, they cut another $10 billion on Wednesday, brings it only down to $45 billion a month. So I mean, they're still printing a ton, but it's down from $85 billion. But they were like, I got that sense that they were very stern on it, basically choreographing to the markets that they were going to continue to cut $10 billion every meeting until it was all done. And the way they said it was, the economy's strong now, rah rah rah. And it was very unusual to see that, especially after in the morning of Wednesday, we got a GDP number that was 0.1% growth. 1/10, folks. That's basically zero. All right. So here the Fed is coming out. Oh, this economy's great. Yeah, let's rock and roll here. This is great. We're going to continue to cut. And the economy's like, I didn't really grow. So I mean,
couple more quarters like that, it's called a recession.
That's right. That's right. So the question is the Fed just saying? I think to me, the way I take that is the Fed saying, hey, listen, we know that quantitative easing is having no impact whatsoever anymore. Printing money, it's nothing. It's nothing anymore. Not having an impact. So let's get out of it. But we don't want to tell the market, God forbid we tell the market that we actually have no impact and we have no control over this. So let's just pretend and say that, this is all good now. Everything's growing great. Let's hopefully they believe us, because they believed us for the last few years up until now. And hopefully everything kind of goes smoothly from there. That's the way I took it, folks. And it's interesting because the GDP number, right, 0.1%. A lot of analysts came out and said, it was because weather, first 3 months of the year. Okay, so you discounted a little bit on weather. I understand that, but I think there's only so much you can discount at this stage of the game, and we'll see in the coming quarters if that was really true. And I do expect a little. I mean, I think both Nick and I would agree you should probably see a little bit of an uptick off of weather not being a factor. But there's always something. I don't know if Nick, you noticed this too, but it seems like every economic number that's not up to par, it was this cause or it was that
there's
cause.
There's an excuse for everything. I mean, I don't know where these excuses come from, Mike, but they have an excuse for everything. It's amazing.
It'll probably be next one. I could see it already, the headlines. GDP only grows at 0.75% in the second quarter because of the Russian-Ukrainian situation and the sanctions. Right. I mean, right there, done. I print that newspaper right now.
Yeah, they already have it. They have the excuse already. They have a list of them. Check it off.
So anyways, guys, bottom line is that takes us into Wednesday. We're going to come back in a minute here from break and talk about the rest of the week. We're going to project into next week. I want to go over a bunch of different things with Nick here, who's going to give us his insight on the market. But again, let's take a quick break here. My name, Gareth Soloway. I'm sitting here next to Chief Market Strategist Nick Santiago. We're both from InTheMoneyStocks.com, and this is In the Money Stock Market Action on 820 AM News Talk Radio.
Here's Gareth Soloway with more In the Money Stock Market Action on AM 820 News.
Welcome back, everybody. Great to be with you again on this Sunday, May 4th, 2014. I'm sitting here with my business partner and chief market strategist, Nick Santiago. My name is Gareth Soloway, chief market strategist at InTheMoneyStocks.com as well. And really, what I want to get to in this next segment is discussing, more about the markets last week, because I think it's a very important thing to kind of live and breathe the market on a nuanced basis, and that gives you a sense of what will come in the future. And I think Nick would agree that, when we're traders and we trade the markets intraday, if I ever go away for a vacation for a week or two and I'm away from the markets, when I come back, it actually takes me a day or so to really get reacclimated. Would you agree with that, Nick?
Oh, 100%. I agree 100%. You lose a little sense of or feel for what's happening out there. Even when anytime we take a vacation, we come back and it takes us a little while to get our footing.
Yeah, and think about it like this. I mean, a lot of you guys aren't traders at home or listening in your cars, but it's the same thing as imagine if you were to shut off your cell phone for a week, your TV, your radio, all for 1 week, and you had no access to the news around the world, or even in Florida here. You really would. I mean, just turning it back on, there's going to be so many news stories, and you're going to say, whoa, I can't comprehend all this right now. And that's the same type of feeling that we get, and that's why we want to strive to bring you the inside action. I mean, this isn't what CNBC's or Bloomberg's or all these other programs try to feed you with the nonsense, the hype. We're trying to give you the inside scoop about this that you're not going to hear from those, so you can really understand and ultimately make the right financial decisions when it comes to stocks. So just before we get into that, I want to just read the number out here. If you're interested in asking us a question, we always encourage you to give us a call here at the radio station. The number 866-977-4820, 866-977-4820. And again, you can talk to us live on air, and we'll be more than happy to answer any questions you have. All right, getting back to the issues from last week, we're going to finish that up and then go into some new topics. So we saw the Federal Reserve, we saw the GDP number on Wednesday, and interestingly enough, I mean, with the Fed doing what they're doing, even I expected a little bit of a bigger move off the markets, but honestly, it was basically a flattish day. I think we ended slightly positive on Wednesday after all those comments, after the Fed cut QE, after the GDP number, and the market just seemed unsure. Like, what do we want to rally? Do we want to drop back down? And then on Thursday, we got jobless claims numbers, we got income and spending numbers, nothing really earth-shattering in those numbers, but the markets again kind of had a flat day, and it seemed like as soon as the Fed announced their FOMC statement and their policy cut and so forth on Wednesday, all eyes turned to Friday's jobs numbers, the non-farm payrolls number and the unemployment report. And that kind of takes us into Friday, where we actually had a little bit of an early rise in the markets and then a sell-off, slow fade the rest of the day, where we closed almost near the lows of the day. And what we saw from the unemployment numbers, first of all, the non-farm payrolls, 288,000 jobs created in the month of April. All right, so that's a pretty decent number. For the most part, it's a decent number until you kind of use the same excuse that everyone was using for the GDP, except on the other side. So, right, GDP was said to be a lot less than it should have been because of the weather. All right, well, when you get a jobs number of 288,000 in April, you kind of have to use that same excuse, which is, all right, 288,000 jobs, but that's a catch-up from the previous 3 months when a lot of businesses couldn't hire because they couldn't even get people to come into their office and interview because the weather was so horrid. So again, I think that with the GDP number, the number should have been a little higher on weather. I agree that with the jobs data, it should have been a little bit lower. So I think initially that headline number was a great number, and then people started to understand this. But the real essence here, and this is what bugs me and this is what scares me, and I think Nick would agree. If you look at that unemployment number, last month it was 6.7%. It dropped to 6.3%. Now, right off the bat, I mean, that sounds like a great thing. Yes, less people are unemployed. But if you look at the numbers closely, the reason why it dropped was because a huge amount of people just stopped looking for work. And this is one of the things you have to understand about the unemployment number. If, perchance, you're unemployed, but you just decide for a month or two you're not going to look for a job, maybe for a year or two you're not going to look for a job, guess what? You're not counted as unemployed. And that's what we saw. And that's very concerning, because if the economy, according to the Fed, is doing that well, why are so many people just giving up on looking for work, especially when the economy is supposed to be doing much better than it was months ago? So I don't know what you thought about that, Nick, but I mean, something's going on there, right?
Yeah, I always call it the number from the land of make believe. It's just, you just can't make. Who could believe this stuff anymore? I mean, I think the market is starting to realize right now, because that was a number where the market would have just took off that day. We would have saw a 200-point up day and on the Dow, and the market would have just went running higher, and we didn't see that. We saw a big spike initially. And then we saw a sell-off in the dollar yen, which I guess we'll talk about later. But when that happens and that goes down, the stock market can't go anywhere because the liquidity is getting drawn out of the system. So it's the land of make-believe number. I don't know who believed it and who could actually calculate it. I mean, it's just Enron accounting again.
Wow. Yeah. So, I mean, when it comes down to it, folks, I think that's the big thing. And I think that's why you saw an initial early spike in the markets on Friday and then it faded, is because, the jobs number, all right, the jobs number, for the most part, I mean, you have to look at it like the Fed has printed $4 trillion. They're continuing now going forward to print $45 billion every single month. I mean, think about that. I don't think a lot of people, even I can't comprehend $4 trillion. Trillion with a T. But that's what the Fed has pumped into the system. The jobs number, even with catch-up from the bad weather, was only 288,000. And, I mean, is that the best we're going to get now? And remember, the Fed is cutting back on stimulus. So in theory, this could be the best, one of the best numbers we see now in the future. And then you go to that unemployment number at 6.3%, which sounds great. But then if you look at how many people are just withdrawing from the system, not looking for work anymore, and again, a lot of talk's been about the jobs that are being created. I mean, they're not well-paying jobs. We're not getting the high-paid jobs.
Thank goodness for McDonald's. Thank goodness for Walmart. I mean, thank goodness. I mean, if we don't have those companies, we may print a negative number.
Wow. Scary stuff, folks. So when all's said and done, the markets again ended slightly down on the day on Friday. I think, going into this next week, we definitely run some risks of at least a shorter term, bigger pullback. I mean, what do you think about this coming week now that we've kind of summarized last week?
Yeah, I think right now we're budding. The market is trying to get up to that the April 4th high, which was made on the spiders right around 189. 70, I believe it was. And the market's running out of steam here. It just can't get through that area. So the one thing I will say, we're probably looking at this really choppy, sloppy, up and down, whipsaw type market for a little bit. But ultimately what we're seeing, Gareth, with the leading stocks and these high flyers that have fell off of a cliff, we know it's just a matter of time before this market really takes a big slide to the downside.
Yeah, so I mean, I agree with you. I mean, if you look at the last 4 months or so since the beginning of the year, we've done nothing except chop sideways. You had a couple big sell-off days, then you rallied back, then a more sell-off days, and so forth. So are you thinking that this lasts for another few weeks, this type of price action, or is it like maybe another 6 months? I mean, what time frame?
No, I don't think we're 6 months. I think we're probably within a few more weeks, and then get ready. These markets will turn down again in the next downturn, because just look at what we've done already in the month of March. In the month of March, right around March 7th, the market peaked. The market peaked again around March 21st. The market peaked again on April 4th. And now we're coming up to those highs once again. And the market generally, if it can't get through those highs, it will peak again. You'll see another mild sell-off. But seasonality-wise, once we get into the midway point of the year, that's when this market's really going to hit major, major turbulence.
Do you think that the choppiness in this market we're seeing is kind of the distribution effect going on? I mean, are the institutions smart enough right now to be continuing to sell, or do they see the writing on the wall type thing?
I think they've sold a ton already. If you just look at the LinkedIns of the world and the Twitters of the world, these stocks have really tumbled already. But what's happening now is that they're at levels where they look attractive for a short-term bounce. So that's where we are.
Interesting stuff, guys. All right, listen, we got to take the midpoint break here. My name, Gareth Soloway, Chief Market Strategist at InTheMoneyStocks.com. I'm sitting right next to Chief Market Strategist Nick Santiago at InTheMoneyStocks.com, and we're bringing you the awesome action to keep you guys informed and make you ready to profit in the coming week. This is In the Money Stock Market Action on 820 AM News Talk Radio.
Now back to In the Money Stock Market Action on AM 820 News. Here's Gareth Soloway.
All right, back we are here on this Sunday, folks, to bring you more insight into the stock market and make sure you're ready for the coming week, what to expect, what to be ready for, and how to ultimately make money and position yourself. And again, I'm joined by Nick Santiago, Chief Market Strategist at InTheMoneyStocks.com. And again, this is Gareth Soloway, Chief Market Strategist at InTheMoneyStocks.com. So, number one, let's go into a couple interesting little factors here. You were talking briefly about how the dollar-yen on Friday started to slide. I think it initially popped on the jobs data, and then it just collapsed. I mean, what is the dollar-yen? And can you explain what the dollar-yen is, and then why is it useful for us in terms of knowing what the market is doing?
Sure. Basically, every economy, it doesn't really matter what country we're in. The way these countries get their business to perform better is by exports. And the way to get your exports moving or shipping out, and you're selling goods to other nations, is simply by devaluing your currency. So what Japan has done essentially is they're printing three times more money than the Federal Reserve is here in the United States. It may be 4 or 5 times more money now since we started to taper here in the U.S. But they're printing more money than the Federal Reserve to try to devalue the Japanese yen. So if you remember a couple of years ago, Gareth, that we used to follow the U.S. dollar index very closely. And when the U.S. dollar index, that's the U.S. dollar versus a basket of the 6 leading currencies in the world. So when the dollar would decline, the stock market would go up. All of a sudden now, the dollar goes up, the stock market goes up. And really what happened was Ben Bernanke, who was the former Federal Reserve chairman, he went over to Japan. He talked to the Japanese Bank of Japan, the central bank over there, and he said, hey, listen, we're going to need you guys to step in, devalue your Japanese yen, and that'll push your stock market up as well. But it will help stabilize the U.S. dollar. This way we could get the price of gold down, the price of silver down. And what we could do is we'll create this new carry trade. And all the big institutions will short the Japanese yen. That means bet against it, look for it to devalue, and it will help inflate the dollar. And what that does is that stabilizes everything around the world for a while. Well, everybody's kind of hip to it now. All the big institutions, they've leveraged themselves to the hill. And this is why on the dollar yen trade. So they're essentially looking for the Japanese yen to go down. And when the Japanese yen goes down, they have so much more liquidity, they go ahead and buy S&P futures contracts. When the Japanese yen strengthens, meaning the dollar yen chart goes down, what happens is there's no liquidity out there to buy the stock market. That leverage, remember, these funds, these hedge funds or these institutional traders, they're leveraged 20, 30 times. All of a sudden, they're losing on their trade. There's no capital to put to work. And what do we see? We see the stock market here in the U.S. go down when the dollar yen goes down. So if you want to follow the stock market, you just follow the dollar yen like we do every day. And we've done it now, Garrett, since December of 2012.
Yeah, absolutely. Yeah, and that's a great explanation on what's going on.
And
there.
You're not going to hear this on CNBC.
That's
You're
right.
not going to hear this on Bloomberg. This is information that you're getting from actual traders, not from people that are trying to promote propaganda.
There you go. And now you mentioned the carry trade. Can you just explain what the carry trade was?
Yeah, basically what the carry trade is the institutional money is going to short one currency that they know is going to fall. And as long as they know it's going to fall, they're given more leverage to do other things. They could go out and make more investments. So if anybody's out there ever had a futures account and you ever have a really good day and all of a sudden you're making tons of money in one day, a lot of times your futures broker will call you up and say, hey, you're doing really well today. You got a lot of money in equity. I'm going to boost your contract size. I'll give you more leverage if you want. And essentially, it works the same way with the bigger guys, too, except they get a lot more leverage.
So in this case, basically, everyone knows that the Japan is just printing and devaluing their currency. So the big boys are hopping on that trade.
Absolutely.
And then, therefore, they're getting a lot more leverage because it's the no-brainer trade.
It's the no-brainer trade, exactly.
What scares me about that is you and I both know there's never a fully no-brainer trade.
Right. And we've called the action in the dollar yen, pretty much perfect this year. With the exception of about 3 days, I think I was off on one trade, but we've called it, and every move has coincided with a slide when we find a top or a peak in the dollar yen. If someone just overlays a chart of the dollar yen and the S&P spiders, you're going to see the correlation there pretty clearly.
Do you think that there's ever a chance? All right, so all these institutions are leveraged to the hilt, betting that the yen is going to decline. Is there a chance that at some point something happens, whether it's a war breakout, maybe something with Russia and it develops? Could there be a massive spike on the yen that could literally cause a crash in the markets? Is there any chance of that?
Well, I think the yen is already strengthening right now. I think it's in the process of strengthening right now. But the way I've calculated is that it will only go down, probably just around the 98 level. That's ultimately what we've told the members, and that's what we're looking for. But right now it sits at 102.16. So you move down to 98. That means the stock market's got a big tumble coming.
Wow. All right, so guys, just be aware of that. It's good to understand the dollar-yen significance, and if you want to learn more about this, Nick and I are always here to help you guys. You can either call us here at the radio station, or better yet, take the 7-day free trial at InTheMoneyStocks.com to the Research Center. Research Center, again, is our offering. Basically, it's a swing trade investment service where we give out information, we give out trades, we let you understand. It's basically what we're talking about here on just an hour today. You get that every single day, the latest news, the latest projections, the latest cycle dates, you name it, you know exactly what the market is going to do with a high probability rate. So again, you can go to InTheMoneyStocks.com, and there's a 7-day free trial. So we just encourage you to at least check it out, even if you don't stick around because you're too busy. It's always good to get educated on these markets. All right, a couple other things I want to go over. So one thing that really kind of irked me this last week, and it drives me nuts, and I don't try to get too political on this show, but I got to be honest, man, these politicians are just driving me up a wall. And I'm talking about every one of them. Every single one of them. I don't know, Nick, where you stand on this.
Where I stand with them. I have no use for any of them.
Yeah, the inability for them to do anything and get any productive thing out. I mean, and then you get the lobbyists in the mix, which are just pushing their agendas. I mean, it just seems that things are going worse and worse. And one thing that happened over the last week or so that really drove me nuts and showed me how messed up the system is that Pfizer made a bid for AstraZeneca. They made a bid to buy AstraZeneca. Now, most people would say, oh, okay, another buyout on a stock. All right, great for stockholders of AstraZeneca. And by the way, they've rejected the offer right now, but it'll just get sweetened, I'm sure. But you have to understand what's going on here, right? So basically, AstraZeneca is from Ireland, right, Nick?
Yes.
All right, so this is a company in Ireland who has a much lower tax rate than the Pfizer company pays here in the U.S. Now, what a company will do is they'll buy a company outside of the U.S., such as this one in Ireland, and then they'll basically forego their citizenship for the company here and join the Ireland registration, essentially. And what that does is now Pfizer, going forward, will pay a much lower tax burden for the rest of their existence. Unless Ireland at some point raises it, but they're not very likely to do that in the short term anyways. So essentially, these companies are able to buy a company outside the U.S. in a much lower tax burdened country, and they can just merge in with them. And then guess what? U.S. receives a lot less tax revenue. And I mean, I don't know if this annoys you as much as me, but I mean, I pay a lot of taxes. I think everyone pays a lot of taxes. I know Nick feels the same way. We pay a lot of taxes. And here you have companies that make billions of dollars a year, and they're just like, nah, let's buy this company over here so we can pay, instead of I don't know what the rate is, 28%, now we'll only pay 21%. And you know how much money that saves them in tax revenue? Billions of dollars. And that money, guess what? If the government's not receiving it from someone or from a company, it's very likely they're going to come to us. Now, I mean, in all fairness, if we all had the opportunity to do something like that, maybe we would. I don't know, but
I would.
Yeah, there you go. But it should. I mean, this should really irk everyone out there, because Wall Street is just utilizing. I mean, in all fairness, I don't fault Pfizer. I don't, because they're using the system.
They're smart.
They're smart. But what you should do is fault the politicians for allowing this tax code to be able to be manipulated like this, where now money is going to be going across the seas. And now, guess what? The U.S. gets less revenue. That means less money for bridges, for toll, like all this keeping up of stuff. And Nick, I don't even know what to say on the issue. It's so frustrating when you see this.
We have so many companies that have already done that. I mean, the list is, I don't even know where to begin. There's just so many that have already done it over the past several years. So we're just seeing more and more of the same, basically. I mean, they're just doing what is best for business.
Yeah.
I mean, that's really what it comes down to. I think that anybody who's productive shouldn't pay any taxes.
There you go.
I mean, let's just call it what it is. Well, let's have a flat tax or something of that nature. But, listen, the people that go out and work, they work hard, they're striving to make a living. They're the ones that have always foot the bill. They're the ones that are always going to foot the bill. That's just the way it works. That's the way the structure is designed.
So true. And just to take a side note on this, and many of you guys may have heard on some of these financial news stations or websites about Apple and how Apple has $100 billion overseas, and Apple refuses to bring it back to the U.S. because if they bring it back to the U.S., they have to pay a huge tax on it. So basically the idea here is, at least this is what I would put forth, is you got to readjust the tax system so it's basically in line with the rest of the world, or at least in that ratio, because what'll happen then if you do that, then all these companies that are parking billions, and that's with a B, folks, hundreds of billions, in fact, probably a trillion in total.
Probably in the trillions, yeah.
That money would be brought back to the U.S., and guess where it would go? It would go into spending. It would go into the economy. It would go into the shareholders' pockets, maybe as a new dividend payment. There are so many opportunities there, and the government, they're just aloof to it. I don't know what's going on, to be honest, folks, and it just drives me insane, because think about if you took another trillion. I mean, the Fed's printed $4 trillion, but if you took $1 trillion of actual real money, not fake money that's been printed, but real money, and just brought it back to the U.S. and had it go out to the shareholders, go out to everyone else, maybe the economy would do a little bit better. But again, with this tax system the way we have it, with everything going on, it's a mess. It's a mess, and ultimately we're all going to foot the bill in terms of our taxes are probably going to go up, because they're not getting the money from other places. They're going to have to get it from somewhere.
Certainly not going down.
Yeah, there you go. So anyways, all right. Off my rant for the day, folks. Let's go on to another topic. We'll try to find a more relaxed topic, although I'm not sure if there is one. But one thing I was going to bring up here, and this unfortunately is not a relaxed topic, but let's talk a little bit about Russia and Ukraine. I mean, it seems like this issue's been going on for now well over a month, right? I mean, it's been for quite a while now. It's probably one of the slowest escalating conflicts that I've ever kind of read about and dealt with, because every week I'm talking about it to you guys, and it just seems like there's a slight bit of an uptick. And again, I think this weekend, I mean, the Ukrainian military going in and trying to root out some of these Russian separatist groups, and it's some fighting. It's closer to civil war than it's ever been there. But I mean, Nick, I would ask you this: is this gonna? I mean, so far it really hasn't had much of an impact on the market. We're still relatively near the highs, except for the tech sector. Is it going to have? I mean, could it escalate to a point where it has a big impact, or is it?
Oh, it will. It will. This is not something that's going to go away anytime soon. We could obviously see that, and as you mentioned, it is basically a civil war at this stage of the game. And with all the sanctions that are being put on the Russian government at the moment, you have to think that it's going to affect them economically, but more so, it's going to affect Europe. And Europe is a fragile place economically right now. So, I mean, as I think the second half of this year, we're going to start to see all of this weigh on the markets, and the markets they're not going to be able to prop this thing up anymore, and we're going to see some major declines. But that means profit for you and I.
Yeah, there you go, folks. And I think that's the important point, is that, Nick and I may not be super bullish on the second half of 2014 here, just like we were kind of not really bullish on the first half, and that was correct. We haven't really fallen. Well, I mean, in all fairness, the tech sector and some of these Facebooks and LinkedIns have been crushed, so we've been right there. But I think it's more that this market has been choppy sideways and really up and down. But you have to remember that the market is like a being. It's like an entity. And the more that gets placed on its plate, especially as the Fed withdraws liquidity from it, withdraws stimulus, which is propping it up, eventually you got to pay the piper, and that's what it comes down to. So, I'm really glad. I still remember the first show I ever came on here with you guys in early January, first Sunday in January, and I said to you guys, listen, start pulling your money out of the market. I said, put it in cash, put it in somewhere where you're going to get at least a little interest, but ultimately be ready for this market. And since then, we've seen, stocks drop 45%, like LinkedIn, Facebook, and some of these other ones off their highs. Pandora's just down huge. And we've seen the market on the S&P chop sideways, and IWM's taken a pretty big hit on small cap side. And that's been the right move. Right? And again, you haven't seen the market go up. It's gone sideways to lower, and certain sectors have been crushed, like the biotechs. I mean, biotechs, what a killing on those biotechs. But the key is, this is that top. This is that choppy top that we've talked about. Distribution going on. The institutions doing the smart thing, which is unloading. I've tried to encourage you guys to do that same thing. And then ultimately, we're going to see the second half a decent chance of some significant downside. In fact, I honestly wouldn't even be surprised if we see a flash crash type scenario. I don't know, Nick, if you've noticed this, but early in the mornings, like sometimes I feel like it might have been last week, or there was a gap up in the market and a sharp sell, and it may have been last Friday, a week ago Friday.
It felt like we were about to crash.
It did, didn't it?
Yeah.
And, the faucet got turned off very quickly, and kind of it stalled out after about 30, 40 minutes. But, I mean, it was so fast and furious that, I had flashbacks, I know Nick did, about the flash crash, about scenarios like that. So it makes me a little on edge. If something like that can happen, and granted it got turned off somehow, but what if it escalates and just continues? And for me, I'd rather play cautious. I'd rather be safe than sorry in the market. I mean, this is money I've worked very hard to earn. I'm not ready to just give it up in a market just on a whim or a hope that it doesn't happen. So I'd play it on the safe side. I don't know how you feel, man.
I'm completely in agreement. I think that's the right way to play it. You have to really understand and look at charts, and that's what we do here at In the Money Stocks. A lot of people don't understand what they're looking at. A lot of people that are at home just listening to a tip or listening to somebody on CNBC, you're now in dangerous water. You better have a life preserver on out there, and you have to really know what you're doing to navigate through these kind of markets.
Absolutely. So bottom line is, folks, and Nick touched on this just a minute ago, and it's so important for you to understand this. The market can go up or down. All right, we believe it's going to go down in the second half especially. The key is you still can make money. And that's, in essence, who cares about everything else then? I mean, if you as a financial guru for yourself, for your family, can position yourself to make money no matter what the market does, that's the green zone. That's the beauty of it. That's heaven right there when it comes down to it. So I want you just to make sure you might say, well, how do I do that? Come join us at InTheMoneyStocks.com. We'll show you. We've been doing it. One thing I'm super proud about this year, Nick, is that our track record, which is now posted, it's audited, it's time-stamped on our website, our track record for 2014, I think we're up to about 185% net return. That's net, so if you take all the winners and subtract the losers, it's 185% profit this year. Assuming you're never going to put all your money in one play, we recommend 10%, but just putting 10% of your account in each of those positions would have netted you about 18.5% profit in 2014. I mean,
what has the average hedge fund done this year, Gareth?
I think it's negative, right?
Yes.
Yeah, so, I mean, that's a hedge fund who you're paying, was it 220, 2% off the top and 20% of profits to. Now, granted, they're not making money, but I mean, you have to keep that in mind. Is that if you can learn. I always like to use this quote: if you can dodge a wrench, you can dodge a ball. If you can learn the markets, you can profit in any market, right?
That's it. And believe it or not, the down markets are sometimes even better because they're much quicker.
That's right.
So you can profit much quicker than you can in an up market.
Absolutely. So just keep that in mind, folks. We're going to take a quick break and come back. But again, it's a great pleasure to be with you here on this Sunday, May 4th, 2013. Tomorrow, Cinco de Mayo. Hopefully everyone gets a margarita in there a little bit there. And my name again, Gareth Soloway, Chief Market Strategist at InTheMoneyStocks.com. And again, today I'm joined by Nick Santiago, Chief Market Strategist at InTheMoneyStocks.com. This is In the Money Stock Market Action on 820 AM News Talk Radio.
Gareth Soloway with more In the Money Stock Market Action on AM 820 News.
Welcome back, everybody. Hope everyone again is having a wonderful Sunday as we get back into the action. And in this segment, Nick and I are going to discuss stocks. So we want to look out to next week. I think Nick was saying to me earlier, and I don't know if you want to reiterate, your projections are you probably get a little bit of a dip this week a little bit.
I think we could probably sink a little bit in the S&P. I'm not foreseeing a crash type scenario, but I wouldn't rule out a little sell-off this week. I think it's certainly possible.
And just before we get into the next segment where we look at individual stocks, folks, give you guys our advice on certain stocks, Nick just reminded me to touch on one more thing in regards to our track record. What's amazing about our track record, if you play penny stocks, right, you can easily make 100%. I mean, that's a no-brainer. Granted, you can lose 100% too, but what I think is amazing about the track record in InTheMoneyStocks.com is that we really only play large caps, and occasionally, maybe one out of every 20 plays will be a small cap, but we don't play penny stocks. This isn't about that. We play Netflix, IBB, which is the biotech, WFM, Whole Foods, RIG, Pandora, LinkedIn, Qualcomm. These are big names, big caps, and to be able to generate that type of return is amazing. And also, if you look at our track record, folks, we've probably given out 50-plus trades this year, and that's in and out. So we've closed out, since we gave them, 50 trades this year approximately, and we have about 5 losers all year. I mean, think of that's over a 90% success rate. And this is what the methodology does. I mean, Nick and I, spent a long time creating this proprietary methodology, and we've now, again, revealed it more and more to the public. We teach it in webinars, online. We give this information to the average investor in hopes that they take it and they start competing and beating the institutions. Why let these institutions who get free money anyways and then take your money when they get you on the wrong side of a trade? Why let them continue to do that? Instead, step up for yourself, start learning, start educating, and start profiting. So I think that's the key, folks. And again, you can go to our website and check out that track record. It's under free market action on our website, InTheMoneyStocks.com, and you'll see Research Center track record right under there. All right, let's get into some stock action. Nick, you were mentioning your feelings on LinkedIn. LinkedIn is down from $250+ to $147 per Friday's close. They just reported earnings last week. Where's this thing going?
I think it's going to $125.
Wow.
That's where I will be a buyer.
So that's a 50% haircut from the all-time highs.
Sure is. I mean, this thing has been absolutely mutilated from 250 plus. Now it's trading at 147. I still think it has another, 20 plus points to the downside. So we'll look at it around $125. That's where I'll be looking to scoop it up.
Wow. And just for listeners, I mean, is there a technical? I mean, a lot of people may not understand the technical, but what's your thought process behind that? Is there anything?
Yeah, it's completely technical. If you go back and you look at what the stock did in 2012 before it broke out in 2013, that's what I call the scene of the crime. A lot of times stocks like to break out of their position, and then they go back and revisit places they were once before. And the stock has a lot of what I like to call vibration at $125. So we'll look at it at that level. I think that's where the institutional money will come in and support it, and I think that'll give you one heck of a bounce.
So in terms of a bounce, like let's say we were to buy that at 125-ish, give or take, do you think we could get a 10-15% bounce?
Sure, I think, in forget percentages, but I think just point-wise, you could see a $20, $30, $40 bounce.
Wow, that's it. See, now those are the types of trades that are great, folks, especially for those of you listening, because those are the ones where you don't have to worry. I mean, it's not something that you're probably going to be in and out in a day. I mean, this is going to be a multi-week type bounce.
We would probably hold that, but for a couple of weeks. But generally, when the institutions come in and they support an equity, I mean, they're not the guy buying 100 shares. I mean, they're buying hundreds of thousands of shares. They're going to move that equity, and it's our job as traders to know where those points on the chart are. And that's basically what we've done all year.
Do you think that we're talking here about a social media company, LinkedIn. We have Facebook out there. Let me just bring up the chart of Facebook. All of these stocks have really had epic collapses. Pandora, Yelp off its highs. Is this the normal rotation? I guess the one thing I've noticed here is I still remember like the solar surge back years ago, where these things were the hottest things in sliced bread, and you always have a sector that's the super hottest sector, but then they all seem to get crushed at some point. I mean, this is just the normal cycle of things taking place.
It's just sector rotation. It's hot potato, whatever you want to call it, but that's what it is. When the money gets in there, the institutional money gets in there, and then what I like to call the dumb money, which is the retail investor. That's the person that is at home with an E-Trade account, and they want to buy the top. The same people that bought Apple at 700, the same people that bought Google at its high. Or we buy stocks when they're on sale. We buy stocks when nobody wants them, when the news is the most dire. That's when we want to step in and buy stocks. The public wants to buy stocks when they think everything is great, right? They want to buy Sirius Satellite when they hear Howard Stern is going there. But the institutions already knew Howard Stern was coming on board. They bought the stock 6 months earlier. That's hence the saying, sell the rumor, buy the news. And
absolutely. And it's amazing with Sirius Satellite Radio. I still remember that. It was in my earlier days, and I still remember watching it run up, and then the announcement came out. I think the stock gapped up that one day or so, and then that was it. And the stock, again, from that point went from I think it was like $7 or $8 down to like 10 cents.
Yeah.
I mean, and the thing is, the problem is here too, is that the average investor, which you just don't have the information. They're not educated on to what to look for, and that's where Nick and I come in again, and we try to educate the average investor to really stand up for themselves and understand what's going on. But they're basically watching the CNBCs, the Bloombergs, and then they see, Sirius Satellite Radio is being talked about nonstop, or they watch about Apple, right? And I still remember every day Apple was upgraded to a 1,200 price target, 1,000 price target, and the average investor doesn't know any better than to say, listen, if the geniuses, the supposed geniuses who are analysts are upgrading the stock, it's got to be a good buy. But you have to understand the game that's played here, folks. And ultimately, when you see those type of things, it means a top is near or top is at hand. So crazy stuff there, guys. And I hope you guys take a little bit from the radio show and use it to at least help yourselves be on the right side of those trades. All right, so couple other stocks here. I mean, what are you thinking, Nick, on, what's CMG? How about Chipotle? Chipotle, I love, by the way. I'm a big fan. I love eating there. What is the chart telling us?
Great restaurant. Terrible stock right now. Stock's gone from, plus 600 down to 500. Just think about that haircut, over 100-point decline in basically 1 month.
Wow.
I mean, that's amazing.
And that was off good earnings, too, supposed good earnings.
Right, supposedly good earnings. That's why we could care less about those numbers. But this stock right here, according to my analysis, at $450, I'll step in and buy that. That's when I'm going to go in there and buy it. Right now it's trading at $501. $501.77. I will leave this one alone right now, but at $448, $449, $450, I am stepping up to the plate. I will own Chipotle Grill at that level.
And I think it's important to keep in mind, folks, a lot of these food producers, I don't know if you guys have seen meat prices lately, but it's off the charts. It's off the charts right now, and that's going to actually take a bite. But that's the market. That's important to understand here, and I'll leave you guys with this today. The market knows ahead of time. The average person won't know that their earnings got hurt until they report. Everyone else is reading the leaves essentially and saying, all right, listen, meat prices are here. This is going to bite into them, and they're going to get hurt that way. So the prices are automatically getting adjusted. All right. My name, Gareth Soloway, Chief Market Strategist at InTheMoneyStocks.com, joined today by Nick Santiago, Chief Market Strategist at InTheMoneyStocks.com. It's been a pleasure to be with you today. This is In the Money Stock Market Action on 820 AM News Talk Radio. Take care.